Good morning, everybody. On behalf of Ards and North Down Borough Council, I would like to welcome you all to this morning's session on general VAT rules post-Brexit. Our speaker this morning is Richard Blakeman from ASM Chartered Accountants in Belfast. Richard is Senior VAT Manager and provides VAT advice to clients across a wide range of sectors. The session will last approximately 45 minutes with a Q&A session at the end. We would ask that any questions that you may have are added to the chat box, and then Richard's colleague Joe will address them all during the 15-minute Q&A session. Following the session, the slide presentation will be emailed together with the feedback forms to everybody. So I'll pass you over to Richard. Thank you.
Thanks very much, Paula, for those kind words of introduction, and good morning to everybody who's joined us. And it's great, Paula had shared the attendee list with me just before the session, so it's great to have so many with us, and also from such a wide range of sectors as well. I know VAT rules tend to be quite sector specific, so hopefully there's something here for everybody. I know not all of what I'm going to talk about will apply to everybody, but as I say, we can address hopefully any specific questions that you have through the chat function there, and come back to those at the end of the session. Sorry, just moving the slide forward there. Yeah, so I think just, in terms of a bit of an agenda that we've got here on the first slide there, the topics that we'll cover, as kind of general introduction for the VAT rules that are changing post-Brexit, and also we can look at specific areas such as the VAT on the supply of goods, so cross-border movements of goods, and also services, looking at cross-border transactions for services as well. Accounting for import VAT, there's a number of changes that are coming into play there as a direct result of Brexit that actually offer a bit of a cash flow benefit to businesses. So that's another area that we can look at too. VAT reporting, again, it's important, particularly for NI businesses, to be aware of what EU reporting remains as a result of Brexit. So we'll take a look at that. The EU Refund Scheme, which some of you may have used before the 31st of December 2020, and it will continue for NI businesses to an extent. So again, we can have a look at that and see how that works now that we're post the transition period. VAT and margin schemes as well, I think that's worth looking at. It's been quite a topical issue for Northern Ireland businesses, particularly in the second-hand used car market. So we can look at the rules there and how that applies. So just like as a bit of a broad introduction, hopefully a lot of the sort of introductory piece here is fairly well established in people's minds now that we are a good sort of month on from the end of the transition period. Obviously that ended on the 31st of December 2020 at 11 p.m. and we are then moving into this phase where we trade in Northern Ireland under the NI protocol. And what that means for NI businesses is that you really need to make a distinction in your head, I guess, for VAT purposes between goods and services. So as the kind of post-Brexit landscape for VAT in Northern Ireland, I think the starting point is to make that distinction between goods and services. And then if you're looking at trade in goods, then the key thing to remember is that the Northern Ireland Protocol means that Northern Ireland maintains alignment with the EU VAT rules for goods. And what that means, and I guess a lot of the sort of buzzwords about in the media and the Irish Sea border being one of them, is that trade in goods between GB and NI are now classified as imports and exports. Which I think pre-Christmas there was probably a lot of confusion about that, and people were thinking, well, that'll have a fundamental change in the way that VAT is accounted for on NI to GB, or vice versa, trade in goods. But in actual fact, that's not the case. But we've got slides that just sort of walk through that. So there's elements here in terms of the VAT rules post Brexit for NI businesses that aren't changing, but I think it's important to have that awareness of what's changing and what's not, particularly as it is in the run up to the 31st of December. I think there was a lack of clarity on some issues from HMRC. I appreciate that's probably still the case, particularly on the customs side, but really on the VAT side, we have clarity in terms of how the rules are going to work for NI businesses. From a VAT perspective going forward. I don't know if to some extent if a seminar or webinar on VAT is maybe a bit of light relief from the customs side of things. Hopefully not everybody's been kind of mired in a bit of a customs nightmare since the turn of the year, but obviously this session is really aimed to be on the VAT side. You know, customs is probably a more fundamental change for NI businesses to get to grips with, whereas the VAT side, I think, is not too bad in terms of the changes that NI businesses need to get to grips with. So again, we haven't included in the slides any maps. I'm sure everybody's sick of seeing maps with arrows sort of pointing in all different directions in terms of movements of goods sort of here, there and everywhere across the UK and Ireland and the rest of the world. But the way to kind of, I think of the VAT position in terms of the map, if you like, is that, as I say, for goods, NI businesses align with the EU. So we're kind of, for goods purposes, for VAT in Northern Ireland, we're sort of in the EU club, if you like. But for services, we're still very much in the UK club, if you like, and services, the rules for services align across the UK. So NI businesses will have the same rules for supplies of services as GB businesses. So it's that important distinction to make between goods and services. And then sort of, I suppose, underpinning all of that is that Northern Ireland very much remains part of the UK VAT system. So in reporting terms, NI businesses report to HMRC as previously, and you know, that doesn't change. In terms of UK to UK trade, as we'll go on to see in subsequent slides, the VAT treatment, fortunately, can remain broadly as it was pre-Brexit, which I think you know, was a cause for concern, and that potentially could have been a much more fundamental change to VAT reporting. So just moving on, again, a bit of a general slide, this in terms of you know, where we are in overall terms. As I say, there's no requirement for a new VAT registration, so we're still reporting to HMRC. You know, we don't get a new VAT registration number or anything like that, or a second VAT registration number. You know, various things that were being touted as sort of potential ways for how VAT would get reported kind of pre-Christmas have, I think, to a large extent been sort of the route that we're going down, and how things need to be reported is much simpler really than sort of how it potentially could have looked a number of months ago. The XI, hopefully everybody's familiar with Northern Ireland's new country prefix in EU terms. Obviously we're not in the EU, but we're aligned with the EU for the purposes of trade in goods. So it means that Northern Ireland needs to have its own kind of special country prefix, which XI has been adopted as what that is. It replaces GB, so that in VAT terms, the GB VAT number is gone. It's no longer valid, and if you're trading across border within the EU, it's this XI prefix that's relevant, and that's only for goods. You know, again, for services we align with the UK, so that the XI number isn't relevant for supplies of services. And in reporting terms, HMRC have confirmed that Northern Ireland businesses continue to submit a single VAT return with the same boxes as now. So I think, again, you know, that simplifies things for NI businesses. There's probably actually sort of, in many respects, more from a VAT perspective for GB businesses. Our friends in GB have a bit more to think about in terms of changes where, you know, certainly in the likes of their trade in goods, you know, they're no longer in the EU club, as it were. So they need to make a few more changes to the boxes that trade with EU member states, where those get, you know, transactions get reported through the VAT return. So there's some pluses, I guess, for NI businesses. Maybe we were due a bit of good fortune on the VAT side, because we've definitely not had that on the customs side, where, you know, clearly there is a massive amount of extra compliance and sort of administrative burden for NI businesses to deal with. So if we move now to look at supplies of goods specifically, and initially we can look here at movements of goods, supplies of goods from GB to NI or vice versa. So it's still UK to UK trade, but obviously with this introduction effectively of an Irish sea border, we've got a bit more to think about in terms of the VAT, and technically these movements, as we know from the customs side of things, these movements are treated as exports and imports, but from a VAT perspective, there is HMRC have used, it's an article in the EU directives that they're able to sort of fall back on to make sure that the trade between GB and NI, the VAT can continue to be accounted for as it was pre 31st of December 2020. And so there really isn't a lot of change there to get to grips with. Effectively, if you're the seller, then you charge your GB or NI customers VAT the same way as you did before, in line with the normal rules. And the customer can recover this VAT, again, subject to the normal VAT recovery rules. Obviously, this session, we can't go into the detail of all the VAT rules, but, you know, certain businesses aren't in a position where they can recover their VAT. And so, you know, that doesn't change as a result of Brexit. And equally, in the opposite way around, if a GB supplier is making sales to an NI customer, from a VAT perspective, they continue to charge UK VAT as they did previously. There are a number of limited exceptions to that, which we won't get into the detail of here. If your goods have been entered into a special customs procedure, VAT doesn't get charged for on movements between GB and NI. Effectively, the VAT gets accounted for as import VAT. Domestic reverse charge, well, the VAT continues to be accounted for there by the customer as it was previously. There's an onward supply procedure if goods are moving from GB through NI into the EU, which again can change how the VAT gets accounted for if you're a GB supplier. And if you're an overseas seller through an online marketplace, it becomes the responsibility of the online marketplace to account for the VAT. So there's one or two exceptions, but broadly, GB to NI trade and vice versa in goods, the VAT treatment doesn't change. So there is another kind of slight wrinkle in that, if you like. Businesses that are moving their own goods from GB to NI, VAT is due. Effectively, it's obviously it's one business we're talking about here moving its own goods, so VAT is due and accounted for by the business on the VAT return. but the same VAT is recovered, again, subject to normal recovery rules. And there's a bit of a pattern, I guess. Again, in line with the customs, it tends to be more involved for trade to happen GB to NI rather than NI to GB. So again, on the VAT side, if you're moving your own goods from NI to GB, you don't need to do that VAT accounting. So again, it's kind of a reporting function. If you're a fully taxable business moving goods from GB, your own goods from GB to NI, then there won't be a VAT cost. It's just a reporting that you need to account for the VAT and then recover it again before you go on to sell it however you're going to sell it from Northern Ireland. So it's certainly something just to be aware of. Then if we look, keeping on with supplies of goods, if we look at supplies of goods between Northern Ireland and the EU, so if I don't know if we have any aficionados of VAT notices on the session today, but HMRC obviously published a number of VAT notices, some of which are very sector specific and you probably wouldn't dip into much unless you're in that sector. One VAT notice that was commonly used, if you like, was VAT Notice 725, entitled "The Single Market." That notice has now been withdrawn, but for NI businesses, it stays effectively. They've even kept it with the same number, VAT Notice 725. We've got some useful links actually at the end of the slides with HMRC guidance on a lot of the topics we're covering today. But VAT Notice 725 remains. It's been rebadged as, I'll just look at the title here, VAT on movements of goods between NI and the EU. So it's not a very catchy title, but it does what it says on the tin. And it effectively is the old VAT Notice 725 for the single market. And obviously, the reason that the VAT notice can remain largely unchanged is that, as we've got on the slide there, under the protocol, transactions in goods between Northern Ireland and EU businesses and consumers will continue as before. So again, it's back to thinking of NI as being in the EU's club, if you like, for trading goods. And that gives NI businesses the capability to trade with EU customers and suppliers, indeed, on the same basis as we did before. And again, I suppose it's a plus in and amongst all the sort of extra things that NI businesses need to think about, is that we've got this freedom to trade as we did previously in terms of goods with the EU. Although, as we'll see in a couple of the later slides, unfortunately, it means that NI businesses retain some of the statistical reporting functions which the EU requires if you're kind of in the club, as it were. So we've just a sort of example of how this flows through in practice. I appreciate this hasn't changed, so I guess this is a bit of a refresher. But if you're the NI supplier in a transaction and you've got a business customer, so it's a business-to-business transaction, then you don't charge VAT, and the VAT gets accounted for by your EU customer under acquisition accounting, and that is on the basis that you've obtained the EU customer's VAT registration number. Obviously, NI businesses, the VAT registration number, the number itself hasn't changed, but if you're continuing to trade with sort of existing EU businesses, you should make them aware that your country prefix is now XI in terms of them having the right VAT registration number to check the validity of your sort of VAT status. Obviously, if you've got pre-existing relationships with EU customers and you've got their VAT number on your files already, that shouldn't have changed. So, from the point of view of doing trade with EU customers as the NI supplier, there's really sort of no interruption there, and you just carry on as before. And again, in terms of the UK VAT return, your sales would get reported there in box 6 and 8. So 6 being your net outputs, and 8 is the box that's still there for NI businesses to report the fact that they've made a sale of goods to another EU member state. If it's a private customer, if it's a B2C supply, then the default position would be that for supply of goods by an NI supplier would be to an EU customer, UK VAT would be charged. Again, pre-existing rules that haven't changed on distance selling. If you exceed distance selling thresholds in other EU member states, then you potentially need to register in that EU member state for kind of distance selling of B2C supplies of goods. So that hasn't changed. So again, it's something to be aware of, but the rules haven't changed for NI businesses. Again, the XI number is the VAT number to quote to your EU trading partners, and the GB1 is now defunct. And then if we flip that round and you're the NI purchaser in the trade with an EU business, so you're purchasing supplies from an EU supplier, the EU supplier won't charge you VAT, and again you will account for VAT on the UK VAT return under acquisition accounting, and if you're fully taxable business for VAT purposes and can recover all the VAT, then you'll just report the VAT on boxes 2 and 4, which will net itself off, and then box 7 would be your net purchases, and again box 9 is a special box for EU purchases, again evidencing on the VAT return that you've made a purchase of goods from an EU business. I put a paragraph in there about triangulation. So triangulation, if anybody on the call is involved in triangulation supplies, again that there's an EU simplified procedure for triangulation, which NI businesses can continue to use, because we get the benefit of following the EU rules on goods. So some of these EU simplifications will also continue to apply. In very high level terms, triangulation is where if you're the NI intermediary supplier in a triangulation, then you might be supplying to, say, a customer in ROI, but the goods that you're supplying may move directly from, say, Germany, another EU member state, into ROI, and the simplified procedure allows you not to have to register in ROI to account for VAT as though you supplied the goods to yourself in ROI in the first instance. So again, a benefit for NI businesses. Like, we've certainly been involved with a few GB businesses that are needing to register in ROI, because GB businesses aren't in the EU's club, if you like, for VAT, for goods purposes, and they can no longer benefit from triangulation. So that, again, I suppose is a plus from still being able to follow the EU rules. Services, again, as I mentioned at the top of the session, services, we're not within the NI protocol. So, services, we're following UK VAT rules. So all UK businesses are following the same VAT rules for services. And places supply of services is a pretty complex area. There's numerous exceptions to the general rules for places supply of services. Obviously, not time to go into all those sort of idiosyncrasies and exceptions on a session like this. So again, something to be very careful with in terms of where is your place of supply if you're supplying services. But in broad terms, B2B supplies, so business-to-business supplies of services, which fall under the general rule, the place of supply shifts to where the customer belongs. So to sort of give a working example of that, if you've got a supply of services and you're the NI supplier, you've got a French business customer, then again, your supply to them, you won't be charging any UK VAT, and you'll report the net sale in box 6, and then it's the responsibility of the French customer to account for VAT under the reverse charge. So again, that's not really changed since the 31st of December 2020. The VAT treatment effectively is the same there, that as the NI or UK supplier, that you don't charge UK VAT on a B2B supply to a French customer or a customer in another EU member state, for that matter, Ireland, or depending where you've got some trade going on. If you flip that round in the other direction, and the French company is making a supply of services to an NI business customer, and again, if those services are falling under the general rule for place of supply, the place of supply shifts to NI, because that's where the customer belongs, where it's an NI customer. So the French company in turn doesn't charge French VAT, and the NI business accounts for VAT under reverse charge through the UK VAT return. And in terms of boxes on the VAT return, it's boxes 1 and 4. If you're fully taxable and can recover all the VAT, that'll cancel out and not create a VAT cost. And in terms of the net figures, boxes 6 and 7 for that part. So that, again, I think, we should all hopefully be familiar with that reporting mechanism for accounting for VAT under reverse charge, and that doesn't change as a result of Brexit. Looking at obviously the last slide was looking at B2B supplies of services. B2C supplies of services, there are a couple of changes here that do just need to potentially be thought about by businesses that are in this kind of area. B2C supplies, the general rule for supplies of services is that the VAT place of supplies is the location of the supplier. So if you've got B2C supply of services and the UK supplier, the default is that you charge UK VAT. But again, there are cares needed here. There are a number of exceptions to the general rule. So one important exception there is professional services. So professional services are not subject to UK VAT if the B2C customer resides outside the EU. So that would be, for example, if ASM, Chartered Accountants, are preparing a tax return for an American client who's resident in the States, that we wouldn't need to charge UK VAT. And that exception only applied pre-31st of December 2020, where the customer was outside the EU. But obviously now, from a UK perspective, the EU is, as they call it, a third country. We're no longer in the EU. So from the 1st of January 2021, business to B2C exceptions to the general rule, which currently apply UK to the rest of the world, also apply for UK to EU. So an example of that, again, sort of taking it back to our own example, if we are supplying personal tax return services to a customer in ROI before 31st of December 2020, that did attract UK VAT, because in that scenario, the B2C customer wasn't outside the EU. But from the 1st of January 2021, we don't charge VAT on that supply because the supply falls into that exception to the general rule for professional services, and the EU is now considered a third country, and so that means that we don't charge VAT in that scenario. So it's an important one for particularly for any businesses that are supplying professional services to private individuals in the EU, to recognise that where you did charge VAT previously, that you don't going forward. Again, supplies of services, there's an area called use and enjoyment rules, which again applies to specific kinds of services, such as letting or hire of goods and electronically supplied services. And they are subject to these use and enjoyment rules, which broadly means that in certain scenarios the VAT gets accounted for where the supplies are used and enjoyed. And again, it's similar to the last slide, where the EU, we were previously all in the same club, if you like, for VAT. Now the EU is considered a third country, so previously, where the customer was based outside the EU, but the services are used and enjoyed in the UK, then UK VAT would apply. So it's kind of, making sure the UK authorities get their sort of share of the VAT where services are actually getting used and enjoyed in the UK. But again, from 1st of January 2021, those rules now apply for UK to EU, the same way that they previously applied for UK to the rest of the world. So again, EU being treated as a third country. So again, as an example of that, if a Spanish photographer is hiring and using camera equipment in the UK, so that the use and enjoyment of the supply is in the UK, then UK VAT would get charged there. This next slide deals with quite an important change that again has really come about as a direct consequence of Brexit, and probably really primarily to help GB businesses. And obviously GB businesses have to deal with import VAT on supplies of trade with in goods with the EU, because GB, obviously the NI protocol only applies to NI, and the GB businesses potentially would have a significant cash flow problem if they were having to account for import VAT on goods coming into the UK or into GB from the EU. There's a change that has been brought in that effectively allows UK businesses to postpone when the import VAT gets accounted for, and in actual fact, under the new system, which is called postponed VAT accounting, you don't actually pay the VAT as such, you just account for the VAT on the VAT return. And again, it's not far removed from the kind of reverse charge mechanism, if you like, that you account for both sides of the kind of VAT equation, the output side and the input side. Obviously, the input side where you're a business that has the ability to recover VAT. So in a Northern Ireland context, this applies to goods that you import into Northern Ireland from outside the UK or the EU. So remember, if you're bringing goods into Northern Ireland from the UK or from GB, then the VAT treatment is as before. You're getting charged UK VAT as before, and as we've talked about already from the EU, the rules haven't changed, so you would be accounting for the VAT on the VAT return under acquisition accounting, as we've already looked at there anyway. So this is where, I think this is quite a significant cash flow benefit for businesses who do a lot of importing from outside the UK and the EU. And effectively what it allows businesses to do is through the customs declaration, you can indicate that you're applying postponed VAT accounting, and you won't have to pay the import VAT when the goods come through customs. So if you kind of are used to doing that, you'll be used to C79 forms, which get issued by HMRC as your evidence to recover VAT on imports, but obviously you've paid that VAT HMRC issue the certificate, then when you go to do your VAT return, you recover that VAT having already paid it. So the postponed VAT accounting allows you to indicate that you're going to account for the VAT through the VAT return and not pay the import VAT when the goods clear customs, and then account for the VAT itself on the VAT return. And the next couple of slides just show how that flows through. So on the VAT return itself, you account for postponed import VAT on the return for the accounting period, which covers the date you imported the goods. So I guess that's logical enough. And you report, as I said, sort of familiar procedure with the reverse charge. You report the VAT in boxes 1 and 4. If you're fully recoverable, that nets off to 0, and the net purchase would go into box 7. So that is certainly a change. I think it's important to have the conversation there with your customs agent if you're regularly bringing goods in to NI from outside the UK and the EU, to have that conversation to say that you would more than likely want to postpone the VAT so that you get that cash flow benefit. The other kind of sort of operational side of that's important just to be on top of, the way the sort of documentation works to have adequate evidence that the ability to recover the import VAT that you're going to show on your VAT return. What you need to have is a monthly postponed import VAT statement from HMRC, which contains the information to support the claim. To get access to those statements, you can use the link that's on the screen. We'll be sharing the slides after the session. But effectively, you need to set that up so that when HMRC start issuing the statements, that you've got access to them. And again, it's important to note that last point on the slide there, that you'll only be able to access the statement for 6 months from the date it is published. So again, just important to make sure from a record keeping perspective that you get into the HMRC system by following the link on the screen there, and make sure you keep your own copies. So there's a few more areas that I think we can move through fairly quickly here. I appreciate time already moving on. EU reporting, unfortunately, by staying in the EU for the purposes of trading goods, we're still required in Northern Ireland to complete EC sales lists and Intrastat returns. I don't think I've ever talked to anybody who's a particular fan of those. Like, they're a bit of a nuisance, but unfortunately, it still has to be completed. But that's purely if you're trading in goods. So again, it's this important distinction between goods and services. If it's services, and the practice manager at ASM is delighted that because we trade in services, any EU trade that we do, there won't be any EC sales list reporting requirements from the 1st of January 2021. So, I suppose a bonus if you're trading in services. It's no longer required to do an EC sales list. The VAT return, the next couple of slides just lay out the VAT return, I suppose, just as a reminder for everybody. The boxes, a lot of those, I think we included these slides just because we've talked about some of the boxes there earlier in the slides, just to refresh everybody's memory what box carries out which function. And again, the important ones from an NI business's point of view to sort of remember are boxes 2, 8 and 9, which are specifically the boxes for the trade with in goods with EU member states. We do see, working in practice, frequently businesses sometimes get confused and put supplies and services in those boxes, but those boxes are purely for trade in goods. So again, in a UK context, it's only NI businesses that need to worry about those boxes going forward. GB businesses won't complete those boxes for your trading goods with the EU. The EU refund scheme, again, it's one that we sometimes get involved with for clients. To be honest, it's a bit of a compliance nightmare. If you're regularly incurring VAT in EU VAT, then obviously there will be a benefit to making claims. Sometimes the amount of VAT that's at stake doesn't merit making a claim. The sort of an extra administrative burden to do it outweighs the amount of VAT that potentially can be recovered. NI businesses can still submit EU refund scheme claims for goods where VAT's been incurred in the EU, and the EU VAT refund scheme is still there the way it was previously. Obviously, there's a number of conditions that need to be met, and the businesses who incur the VAT on goods in other member states, that has to be criteria that's met. You have to have a fixed establishment in the country from which a claim is being made, and not registered or liable to be registered in a country from which a claim is being made. So if you tick those boxes, you can still do your EU refund claim, but it's only for where VAT's been incurred on goods. Again, the detail on that slide is really the specifics of the EU refund scheme. I don't think merits going into that in a lot of detail, but there are minimum claim limits and certain exclusions where claims can't be submitted. But it is important to remember that if it's VAT on services, potentially that can still be recovered, but not through the EU refund scheme. Effectively, an NI business would need to use the existing processes for non-EU businesses. So remember, for services purposes, NI is non-EU, and the process for doing that will vary across the EU from country to country. So it's just a question of following each separate country's rule. Again, it can become overly cumbersome if the amount of VAT doesn't merit it. Margin schemes, we'll just go very quickly through margin schemes. I appreciate it doesn't apply to everybody. So margin schemes have sort of been in the news, I guess, quite a bit, particularly with regard to second-hand cars. If it's other goods such that follow the second-hand margin schemes, so sort of antiques and so on, unfortunately those schemes are no longer available where stock has been acquired from GB and is being brought over to NI. So that again it was causing the second-hand car businesses a lot of difficulties in terms of the impact it would have on their margin and profit levels and the prices of cars that would result in Northern Ireland. So there's been a lot of lobbying just within the trade, and HMRC have got agreement with the EU that the margin scheme can continue for second-hand car dealers, and effectively how that works is when a car is bought in GB and transferred to a dealership in NI, the VAT is accounted for as a movement of own goods. So if you remember back to the earlier slide we had on that, effectively you account for both sides of the VAT transaction yourself as the dealer, and then you can use the margin scheme for cars that you've purchased from GB. So it's a good result, I guess, for the sector, and that the margin scheme can continue to be used. So we can probably just wrap up the session for me speaking anyway, in terms of the next slides, just kind of summary slides. Again, I promised that there was a number of useful links, a lot of detail obviously kind of being issued by HMRC on the VAT side. Those are the latest links, such as they are now. hopefully HMRC don't change the links. That's been a bit of a problem sometimes when we've been issuing guidance to clients that they change the odd link. But if you are finding that, probably just Googling the title that's there will get you to the up-to-date page. There are constant updates to these pages, or there certainly have been sort of in the month of December and January. But a lot of what we've talked through there, that's the relevant HMRC guidance, and should hopefully prove very, very useful. And that's Brexit checklist. Again, like, we're not going to talk about customs on this session, but just as a reminder for sort of where NI businesses should be at in terms of the steps that to go through, just to sort of tick the boxes that you're sort of Brexit ready, and particularly in terms of the trade between GB and NI, which is obviously where a lot of the customs complexities lie. So hopefully that was a useful oversight for everybody, and appreciate, as I said at the outset, not VAT is quite a difficult topic to talk about sometimes when you've got a wide sort of audience, because not all the areas will apply to everybody. But hopefully that gives a good overview of the changes. I mean, I think in summary, the overall picture for NI businesses from a VAT perspective isn't too bad. The changes are relatively minimal. It's almost sorting out what hasn't changed following a lot of speculation that things, more wholesale changes might be on the way. But there certainly are a few subtle changes there, particularly in regards to the accounting for the VAT on imports, and some changes obviously as we went through there on B2C supplies of services. That as a direct result of Brexit, there is a fundamental change in the way VAT gets accounted for.